So when it comes to the whole deal street, you have been quite active, at least in exploring the options. We had Max, we had Canfin Homes, we had Star Health Insurance, and there are many other assets which are available right now. What's your view when it comes to something like a PNB Housing Finance and other housing finance companies?
We have said categorically that we are not interested in PNB. We were not interested in PNB Housing. We've clarified that to the market. See, what we have to understand, this is nothing to do with PNB Housing, so please understand that. That when there is any acquisition that you are looking at, one has to look at a culture fit also.
Right.
I'm not in any way referring to PNB Housing. I'm just making a very generic statement. That lending, the business of lending is a certain set of values, a certain set of ethics, a certain set of culture that you create. And just going and acquiring something because something is available in the market is not the right strategy, because at the end of the day, the fit has to be right.
Right.
So we keep our eyes and ears open. If an opportunity does come up and we find that the fit is right, we would be happy to look at it.
So another important aspect of deal making, besides the integration issue or integration hurdle that you mentioned, and many other corporate leaders have also voiced the same thing on M&A. But the other bit is also what amount of cash goes in or how dilutive it can get. Is there also that constraint of a cash deal or an equity deal that is playing on your mind?
No, I mean, any deal that you do, it depends on the size of the deal. It depends on so many factors. Yes, there could be a deal where there is part cash. There could be a deal where there is part shares, or it could be all cash. It could be all shares. It depends on the deal. I don't think there's any particular view one way or the other. If it is accretive to the business, then some degree of cash followed by some degree of shares, which also makes sense, because at the end of the day, you're getting a lumpy growth in your balance sheet.
Okay, why
so I mean, it's an open question. It depends on the facts of each case.
Okay, why I asked you is because in Canfin Homes we had seen similar such constraint, and in PNB Housing Finance also what we gather is that several of the strategics had reached out, and now the company is probably open to a cash and share deal. From earlier only cash deal. So does that change the amount of interest
not
that...
Really. Not really. Frankly, not really.
All right. So, Mr. Mistry, when it comes to the other subsidiaries and the businesses that you have created under the umbrella of HDFC Limited, and you've rolled out 2 in terms of listing in the last 1 year. So, you have been quite active in that particular way. So, now what is the next stage of growth and value creation for the shareholders that you're looking at?
See, we created value over the years in building up these subsidiaries. So today, HDFC's value doesn't come only from the mortgage business.
Right.
It comes by virtue of not just having the mortgage business, but also being a holding company which has equity in the bank, in the life insurance business, the general insurance, the asset management business, and so on. In fact, the unrecognized profit on our listed investments on 30th of June, this is only on listed investments, and unrecognized profit, not value, was 1,68,000 crores. And that was at a time when the AMC was not even listed. Now with the AMC listed, that 1,68,000 crores will become a lot higher. So we carry a huge amount of unrecognized profits on our investments. So that is the value that we have created in the market. We have given birth to a number of companies. We have HDFC Asset Management and Life Insurance, which is listed. Bank, of course, was listed many years ago. We now have HDFC Credila, which is an education finance business. I talked briefly about HDFC Credila, saying we infused some capital into that business recently. We have HDFC Ergo, which is a foray into PNC insurance. At some point of time, over the next 3 to 5 years, we would certainly look at listing these companies. But we have to do it at the right time. It's not necessary that we have to do it to this year or next year. But when we believe the time is right in terms of getting sufficient size, then that is a time we would look at listing these businesses. But these are businesses which at some point of time could be listed.
So you talked about HDFC Ergo, and you have made several attempts at looking at other assets also. So is it going to be 2 general insurance and health insurance separate? Is that the strategy, or all rolled into one?
The ideal strategy would be that HDFC general, subject of course to regulatory requirements being complied with, that HDFC General Insurance sets up a wholly owned subsidiary or carries out the health insurance business as a subsidiary of HDFC General Insurance. That's the ideal strategy that we would like to look at, subject of course to it meeting regulatory.
Right, and what is your view on the growth for GRU Finance, because that's also growing fast?
GRU we hold 60, little less than 60, about 57, 58% of the equity. GRU has done extremely well in terms of stability. Its return on equity is over 30%. It's been growing at a compounded rate of over 20% a year for probably 20 years or more. It does not require capital in any way because its capital adequacy ratio is still very high, and it's growing at a stable pace. It lends money to a category of people that HDFC does not generally lend to. Their average loan size is much lesser than HDFC. The average loan size is about 7 to 8 lakhs rupees, and they handle their asset quality extremely well over the years, with their gross non-performing loans being less than 50 odd basis points and fully provided for.
So in terms of strategy, you would rather have small ticket loans being pushed through GRU Finance and you stay in your average ticket size?
That's right. Something like that. That is probably the strategy.
And do you think also that to beef up GRU Finance, an inorganic route can also be taken to?
Frankly, we've not considered that. We've not considered any inorganic growth for GRU, at least at this point of time. We've not considered it.
All right, and when it comes to life insurance business, now that's doing well. In fact, the stock has been performing very well as well. Now, what is the next stage in terms of strategy and growth for that company? And inorganic growth in that also is something to beef it up further?
It's something we are happy to look at. We did look at Max at some point of time a couple of years ago, and then we went for a listing and we said we were not. But yes, we are open to inorganic growth. It's not that inorganic growth is the only way to grow. If you look at our growth numbers have been strong, and this is despite the fact that there has been no inorganic growth that we have done in the life business. We've done some inorganic growth in our general insurance business, where we bought over L&T General Insurance a couple of years ago. But in the life business, we've never had inorganic growth, and despite that, we've had a stable growth. So our profit margins are good, and we would like to consistently keep growing and keep eyes open for any inorganic growth opportunity which exists.
So, Mr. Mistry, is there any chance that a Max Life deal may resurrect anytime?
There's no discussion with them at this point of time. So I don't know, it's a hypothetical question. But there is no discussion with them.
Why I asked you inorganic is that's not the only way to grow, but then an industry where you're one of the leaders, then consolidation is also a theme which is playing out in this industry. So would you play a consolidator at a time like this?
I told you that in any of our businesses we are open to inorganic growth. But there is no inorganic growth discussion that we are having with anyone at this point of time. So there's nothing at this moment, but we are open to it. If the right opportunity comes up, we are happy to look at it.
Let me ask you a question. You have explored the opportunity in various sectors, various pockets of financial services, and you've seen many companies as well. How have been the valuation expectations? What is your thought process as a buyer in, say, housing finance to start with?
Well, we did see in Can Fin Homes that we made a bid at a certain price which we believed was the right price, and they found that the price that had been bid was lower. They wanted a higher price, and therefore we did not go further. So at the right price, and that price will vary from business to business, an acquisition makes sense, provided the culture fit is there, provided the value systems are in place, and so on and so forth. But at any price which is higher than what we believe is a fair price, we are not interested.
Even in health insurance as well, you did look at Star Health. Now it's gone at 6,500 crore rupees. Having been in the insurance space now for a while, how do you measure the valuation expectations, these valuations?
Well, it's not for me to comment on why the Star Health valuation is 6,500 crores, but our valuation was lower and we put in a value at that price.
So how is the succession planning shaping up with so much depth and talent in your company?
Well, people have been around. There's no succession there's no imminent succession that we are sort of looking at. But succession is something we always have in mind, and we have an inherent pool of talent of people who can fit into various roles. So I don't think succession, to my mind, is an issue anywhere.
A final merger of HDFC Bank and HDFC, is that at all on the anvil?
Frankly, no, not at the moment. It's something, to my mind, which makes sense. I've said this time and again. But there are regulatory costs associated with a merger, which makes the whole process, the way the regulations are today, very costly. The regulatory costs are in the form of a cash reserve ratio, in the form of a SLR requirement, in the form of a higher priority sector requirement, because HDFC itself is not subject to CRR, SLR and priority sector lending, but the bank is. So if HDFC merges into the bank, then on the entire existing balance sheet of HDFC, which is large, we will create the requirement to have a CRR, SLR and priority sector lending. So unless and until there is some regulatory concessions that are provided by the regulator, the process is very costly. So there is no discussion with the bank. We are both listed companies. We recognize that recognize the fact that we cannot make arbitrary comments on merger. We have had no discussion on the subject of merger for a very, very long period of time.
Mr. Mistry, my final question to you would be that there is a lot of talk of Amitabh Chaudhry really making it as the CEO of Axis Bank.
That's what I hear from you. I have no idea. I have absolutely no idea.
All right. Thank you so much,
Mr.
Mistry, for joining us.
Thank you very much.
Thanks.